All right, we are moments away from the start of trading, about 20 seconds to be exact. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. This time yesterday, of course, we were talking about all that enthusiasm in the markets, in big tech, over that AI pact that was shepherded by Donald Trump, $100 billion of investment. Now you're seeing some of that euphoria fade a little bit. We got some reality checks on the earnings front. Of course, we have a blackout when it comes to Fed speak. So we're looking for the next catalyst right now. You can see, though, at the two stock exchanges, people are clapping. There's a lot of excitement down there. But if you switch up the board and take a look at how we're doing in the first few seconds of trading, it's none too pretty. You're seeing yesterday's action, of course, right now. And you had that big rally in the NASDAQ 100. It's faded and then some today. The NASDAQ 100 down about 0.5%, 0.5% if you want to be fancy. Of course, the chip makers in the hurt locker a little bit today. The S&P 500 faring a little bit better here, down by only 0.1%. There's a lot of daylight between now and 4 p.m., so we'll keep a close eye on that one. But the Russell 2000 also seeing some pain this morning, down about 0.5%. We are seeing that slight rise in bond yields. We're back above 4.60 on the 10-year Treasury yield. A quiet climb, but making itself known in the small caps. Let's take a look under the hood here. I mentioned those disappointing earnings, and you can see that in American Airlines. Lower after unexpectedly forecasting a first quarter loss. That's in contrast to the more bullish outlooks we've seen from rival airlines in the past few weeks, and you can see that surprise in shares right now, currently down by almost 9%, Sonali.
We'll dive more into that one. Serious surprise there. Electronics Arts, even a bigger surprise. You're watching it down more than 16% as the market opens. The video game companies missing forecasts after two of their most recent games failed to meet expectations. Tough blow in what has otherwise been an exuberant earnings season. But also looking at chip stocks falling. If we flip up the board here, results from Korean memory chip maker SK Hynix failed to impress. And it's bringing down NVIDIA, Micron, and ARM to the tune of 1.8% for NVIDIA. Micron down even more than 4%, and ARM down 5.9% nearly, Katie.
All right, let's broaden out this conversation now with Ethan Devitt. She is Moneda's Chief Global Market Strategist, joining us now. And Ethan, it's day 4 of Donald Trump's second administration. We've seen a lot of action when it comes to immigration, AI, tariffs. We've heard J.P. Morgan is setting up war rooms to examine all these executive orders that are coming through. How are you separating the noise from the actual signals here?
That's a great question. You said it. There has been a lot of action, this flooding of the zone of all kinds of executive orders, tariffs one day, no tariffs the next, or a more lenient attitude to tariffs one day. It's actually a lot to digest, and markets abhor uncertainty. And as you can see with this on again, off again risk sentiment, it's been a very difficult market to navigate. And we do know that a lot was priced in, and we certainly thought this was dollar dominance. That was the code word of last week, pre-inauguration. And now we're actually seeing some dollar give back, as it does seem that not every trading partner is essentially a sitting duck for whatever trading policy the U.S. wants to impose. So there is a sense that perhaps we maybe oversimplified the situation going into the new administration. So quite a lot to digest this week.
The on again, off again risk appetite out there seems to be a difficult thing for a lot of investors to navigate, as you had mentioned. The S&P 500 yesterday closed less than 5 points away from a record high. And today you're watching that risk off moment once again. What would cause you? What do you need to see definitively to be risk on once again?
We need to see clarity around regulatory change, around tariffs, around perhaps working with the Federal Reserve in terms of knowing that they will be mutually supportive in terms of the administration. There won't be rhetoric against them, because that's exactly what the Federal Reserve has worked so hard to do over the last 18 months, is to restore its reputation, to be very clear, very data dependent, and have no surprises. So in order to be firmly risk on, we need to know that many of these concerns, which are keeping investors up at night regarding inflation, the direction of the Fed, what's going to happen with tariffs, what that would do to the U.S. economy, all of that needs to be put to bed a little. And all we need for that is clarity.
Clarity. Let's layer that conversation and that need for clarity on top of the earnings picture that we're getting so far. It's early yet, but you think about Electronic Arts sinking by 18% at one point. That is the biggest drop since 2008. You also have American Airlines having a pretty painful morning as well. Is that a little preview of what to expect when we get deeper into earnings season, that if you miss, you're going to be punished in this market?
Absolutely. You named two sectors there, and we've seen a very similar sell-off, and we saw that in the obesity drug sector as well. So it's a very sharp sell-off, a sudden disgust perhaps, or a sudden concern around the frothiness. That is a symbol that markets are on edge and waiting perhaps for something to tip over. And we've seen that in certain sector by sector. Similarly, there will be differentiation within sectors. So that could be a good market for active stock pickers. They've been claiming that this is a good stock picking market for some time now. We haven't exactly seen that. It's all been about the index shares, and we've seen flows out of active managers as a result. But I do think that more differentiation is likely, but clearly no sector will be immune.
When you think about what we're going to see next week with the big tech earnings as well, how do you expect them to perform, especially after such a big run-up? If Netflix was just a taste of outperformance, do you think the others can live up to the hype?
I think we have to put all this in context. Let's look at the inauguration at the beginning of the week. We saw this astonishing display of the tech titans side by side with the highest order of politicians. And we know that they have firmly a place at the table. They're optimistic. They are reining in some of their policies that didn't concur with the Trump administration's policies. And they're poised for exciting 4 years ahead. So I do not see anything. I think we know that they've been telegraphing earnings well in advance. We know they have the margins to justify it. We know they have the pricing power. And if there's uncertainty around regulatory developments, possibly around the regulatory eye that's on tech companies, again, we hardly heard anything about that in the executive orders. So I'd say they're feeling pretty optimistic at this point. Now, what we've seen in the chip stocks this week is a concern that perhaps too much has been baked into these prices. But I would say the tech companies are probably ones not to bet against at this juncture.
That's interesting. And I want to wrap that into the political landscape as well, because you think about Monday's inauguration, you had all the big tech CEOs there in a prominent way. I mean, you think about this antitrust, this regulatory overhang that has really clouded a lot of these big tech names. As an investor, how do you read the fact that you do have these tech CEOs seemingly cozying up to Trump? Does that matter to you, or is that something that maybe is more towards the fringes?
It matters in a very positive way, I'd say, just in terms of why are they doing this? They're doing this to clearly align their interests with those of the new administration. They want no surprises. They want to be inside the tent. And being inside the tent, I think, assures that there will not be negative or perhaps politically motivated attacks on their positioning. Maybe no attempts to unbundle. I think it's very shrewd tactics on their part to get inside the tent. I'd say as an investor, you feel safer that way because you know there will not be a targeted, perhaps, regulatory change. And I'd say now it's about closely watching just how well this marriage works out, because it is a new one. It's a new set of chemistry, certainly a change from the first administration. And we've already seen with Doge that one of those leaders is gone. So there will be friction. These are big egos at play, a tendency to be competitive. We know that from the space race that we saw quite recently. So I'd say watch this space.
We're going to hold that thought on Doge, talk more about it later in the show.
I cannot wait, I have to say. That'll be fun.
It's been a lot of news, when you look at the Russell 2000, that's another thing Katie and I have been talking a lot about. You look at it from the November heights, and it's down almost 6% already. Part of that was fears around what you saw in terms of interest rates on the longer end of the curve. A lot of these firms have a lot of debt. As we know, many of them are unprofitable. But this has been a big trade. This has been a hopeful trade, and it's been a trade that's been expected to do well under the Trump administration. Would you buy this dip, or do you think that there's still uncertainty in terms of performance there?
I would buy the dip, yes, because I do think it's been overdone. And also, we need to rebalance our equity portfolios at all times. So we still believe in a balanced equity portfolio between large and mid cap and small cap, as well as also non-US and US. So we're still somewhat traditional in that respect. But I would say in terms of what's driving it, we can see that there was an expectation that America First would be good for those that are not dependent on international trade, that are not affected by a strong dollar, and perhaps don't have as much leverage. So we're not going to be subject to needing to refinance even at these still higher interest rate levels. So a lot was tailwinds in terms of small and mid cap, but they've just failed to deliver according to expectations. We still see a lot of the momentum behind large cap tech. As I mentioned, that's now almost a risk off trade in equities is to be large cap tech, even though it's volatile, even though it's well priced. And as I mentioned, the fundamentals support that. There's a little bit of reticence around buying into mid-cap at the moment. It has been trailing. It's a more defensive type of sector. So I would say, yes, but in terms of whether I would buy in the dip.
All right, and to that point, I mean, you take a look at, it's early yet, Shonali, but the NASDAQ 100 outperforming, the Russell 2000 underperforming. It's a story we're pretty used to at this point.
We've been so used to it, and you have to wonder whether the earnings season can give investors something else to chew on. Bloomberg Intelligence, just reading this morning, said that they think healthcare is going to outperform. I know that's been a really exciting sector that you've been digging right into.
Yeah, and DataTrack, to that point, one of our favorite research shops out there, saying it's too cheap to ignore, but Ethan, we got to leave it there. Great to speak with you. That is Ethan Devitt of Moneta. Now coming up, airlines on the up and up, except for American, that is. More on that next. This is Bloomberg. Welcome back to Open Interest. You take a look at the stock market right now. Not too much change to report. The S&P 500 down about 0.1%. A lot of that weakness being led by what you're seeing in big tech right now. Though losses coming back a little bit. The NASDAQ 100 down about 0.4% right now. And it's a similar story if you take a look at the Russell 2000 down about 0.4% as well. We'll continue to track the movement there. But it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Boston Beer downgraded from overweight to neutral over at Piper Sandler. The analyst citing slower than expected sales growth of Twisted Tea. Next up, healthcare software Veeva double downgraded over at Goldman Sachs from buy to sell. The analyst cites competition from Salesforce and says that a fundamental recovery in the life sciences vertical is likely to be slow. Shares currently off about 4.5%. And finally, we have Netflix upgraded at Wolfe Research after its strong earnings report. The analyst says that the outlook buried long-standing concerns about a deep slowdown. Netflix adding another 2.3%, Sonali.
And in earnings news, we've been talking about it all morning because it's seeing a pretty strong dip here in the market. American Airlines forecast is a surprise first quarter loss, and it's braked from rival carriers that have been cashing in on unusually strong winter demand and pricier domestic fares. By contrast, Alaska Air forecasts a smaller than expected loss in the first quarter, and GE Aerospace announced a $7 billion stock buyback after topping profit estimates. You can see the dispersion there at all the stock prices. And joining us now to unpack it all, George Ferguson, Bloomberg Intelligence's senior aerospace, defense, and airlines analyst. Want to just go right into what's going on with American Airlines because, of course, there's today's story. You're seeing the stock really fall the most here intraday since May of last year. They have underperformed their rivals generally, and you do have analysts weighing in, citing concerns about costs outside of fuel, in addition to other missteps in the recent quarter. What would you look into most in terms of what's going to matter for them in the year ahead?
Yeah, so I mean, I would start by saying I thought they had a really good quarter, right? And their revenue performance was as good as, if not better, than their peers, United and Delta. And look, I mean, I think, there's only 3 big full-service carriers in the U.S., and American made a misstep by trying to do a lot more direct bookings than, getting through travel agencies. They've changed that, switched back to taking more travel agency bookings. And I think you can expect that they're going to catch up, right? It's not like United and Delta are going to be able to run away with the business. Now, for 1Q, they're going to put less capacity into the marketplace. They just signed another labor agreement that's going to increase costs. So their costs are rising high single digits, where you've got United and Delta rising mid-single digits. Look, they said by the back end of the year, 2025, they'll lay in more capacity and they'll get those cost increases down to mid to low single digits. They'll perform probably as well as United and Delta. Again, they've got ground to make. They've been the underperformer. They've got ground to cover to get there. But I think that you'll continue to see them close that gap. I don't think, again, United and Delta are going to walk away with this business.
That's really interesting, George. It sounds like what you're saying is basically this 9.3% plunge that we're seeing in American right now is a bit of an overreaction.
I think so. I do think so. Again, 1Q is going to look worse than the other 2, but I still think they're all 3 working in the same marketplace. They have very similar, routes and regions they fly to. It's going to be really hard again, I think, for American not to be able to catch up to rivals.
I also want to go to GE with you for a moment here, George, because you are looking at just a stunning capital return story in addition to what has been a very high-performing stock in the past year. You're looking at shares up about 8.6% right now as well. How much juice do they have to really still take out of this performance story? What does the year ahead look like for them?
The delays in new aircraft deliveries from Boeing and Airbus have really sort of driven in the marketplace the need to fly older airplanes longer. And GE and the other engine makers, but remember, GE is the biggest and the best engine maker globally. They have really strong market share in narrow-body aircraft and wide-body aircraft, unlike their rivals. So they are really benefiting from this desire to fly planes longer, and therefore you need to maintain those airplanes. That maintenance business is very large margin business, and so I think it'll be a tailwind into the next year, into 2025 for sure. I think it starts to tail off into sort of 26s, 27 timeframes, but really long, these are long trends in this business, and so GE is really generating some great cash and really nice margins right now.
George, we thank you so much for your time and analysis. A lot of news in your sector this morning. That is George Ferguson from Bloomberg Intelligence. Now, coming up, Elon Musk takes sole control over Doge as Vivek Ramaswamy exits. And we're going to look at the future of the department in our Wall Street beat next. This is Bloomberg. It's time now for the Wall Street Beat. Today we're looking at the divorce between Elon Musk and Vivek Ramaswamy as it pertains to Doge. For more here, we are joined by Max Chafkin of Bloomberg, follows Elon Musk closely, and people out, people in. I'm also looking at this story this morning in the Wall Street Journal. Michael Grimes, who's a star banker at Morgan Stanley in the technology industry, big part of taking Tesla public, big part of Elon Musk buying X, might leave Morgan Stanley, go to Doge. Are they going to pay him?
I mean, look, if you're a deal maker, this is where all the deal guys are right now. So it makes sense in that way. I don't know. There are definitely a lot of sort of big names who are close to Elon Musk, sort of friends of Elon, who are providing, informal advice. Reading the Wall Street Journal's report, this sounds like
Mark
potentially
Andreessen.
A more formal role. Yeah, Mark Andreessen and David Sachs and others. So on the other hand, we're also seeing Vivek Ramaswamy, essentially out at Doge and running for governor. So it's a bit of a revolving door right now.
So two things. One, it's confusing that his name is Michael Grimes and not Grimes, the musical artist, who, of course, has given birth to several of Elon Musk's children.
He likes the Grimes.
That's true. That's true. It's an appealing name for him. Number two, when we say a job at Doge, is it really a job with a paycheck, or is it sort of on a volunteer basis?
There have been conflicting reports, even conflicting reports from Elon Musk and Doge. Initially, Elon Musk said it's going to be volunteer. You're going to have to work 80 hours a week. Doge, the Twitter account, which may or may not be an official government Twitter account at this point, has also listed actual jobs, it appears, in HR and finance and things like that. So my supposition is that there are going to be some people who are actually paid, but a pretty small number. It is a government efficiency commission, after all, as well as a healthy sort of group chat. I mean, it seems like a lot of what Doge is, some of Doge is inside the government. Some of it is this kind of almost like political advocacy group, with Elon Musk's Twitter at the head, advocating for essentially Donald Trump's policies.
So if we look on average, just days into the administration, is Musk now closer or less close to Trump, given what he's doing with Doge? Because this was supposed to be an external body, not an internal government body from the beginning. At least that's what Ramaswamy wanted, according to the Journal.
Yeah, the conventional wisdom all along is like these guys their egos are too big, they won't be able to last. And that is not what we've seen in any way. Musk, according to reports, is working out of the West Wing right now. He was in the Oval Office when Trump pardoned Russ Ulbricht, the crypto-convicted Silk Road founder. So he is very close. There is no sign that they are falling out or anything like that. Although Musk is giving Trump plenty of reasons to potentially push him aside if he ever wanted to.
Well, let's talk about AI, and that AI JV that was announced yesterday or 2 days ago with the $100 billion of investment coming from SoftBank and OpenAI involvement as well. Sam Altman, Elon Musk famously don't get along. When we think about the future of the relationship between Musk and Trump, could this be a potential breaking point?
Possibly. If we were talking about this AI announcement, we would be saying, critics are saying that this $100 million or $100 billion or potentially $500 billion thing is just a marketing thing and they're never going to fund it. It's not going to create any jobs. Turned out yesterday, one of those critics was Elon Musk, who spent about half the day calling Sam Altman, quote, a swindler, calling the announcement, quote, fake, posting all of these tweets from, years ago where Sam Altman had supported Democrats, really undermining, President Trump's big infrastructure announcement in a way that felt kind of extraordinary, just given the fact that Elon Musk is in the administration.
Yeah.
And of course, as you say, Katie, that is the feud with Elon Musk and Sam Altman, which goes back all the way to the founding of OpenAI, the creator of ChatGPT. It goes all the way back to the founding. They are in litigation together. So I don't know. We're going to see this continue.
I do wonder if it means that Trump's relationship to Sam Altman, therefore, is going to become closer and closer, and whether that spells a little bit of trouble for Satya Nadella, who was not in yesterday's announcement.
One thing I'll say is Elon Musk has a point. Like, it is not clear that this $100 billion or $500 billion is there.
Right.
And you are right. There is potentially, I suppose, a threat here to Microsoft. Although, again, it's not clear how much money is really behind behind this. So how big a threat, I don't think we know yet.
Well, it's really fun comparing who's in, who's out, how that might change. Max Chapkin, fantastic reporting as always. Meanwhile, a quick check on stocks. We're just about half an hour into the session. You can see the S&P 500 still down. Similar story across the indexes. Stick with us. We'll talk to Liz Ann Saunders of Charles Schwab Investments next. This is Bloomberg.